Okay, so today we have long-term assets. And we'll start off with the group that's known as tangible assets, also known as fixed assets, and plant, property, and equipment. So what are the items that would we have under PP&E? How about I tell you? Land, buildings,
Equipment.
Raw material would be under inventory. That would be a current asset, not a fixed asset. Land, building, equipment, machinery,
Natural resource.
natural resources, possibly, maybe not. But I don't want to discourage participation, so I'll put it down. Anything else?
Basket purchases.
Vehicles, land improvements, furniture, fixtures, computers. The list can get pretty long. Not every company has all these elements, and sometimes they combine them. Quite often you'll see an account called furniture and fixtures. So let's start at the beginning. What would be land? What's considered land? The real estate?
Real estate.
So how's the land different from the building?
Which has property on it.
So the land is underneath, buildings on top. Do you usually buy them separately?
No.
Usually buy them together. So how do you separate the land from the building when you pay one price?
In the same situation.
How many people own a house or parents own a house? Did they pay two separate prices for the land and for the house, or was it one price?
One
It's
So
one price.
separate it for the purpose of this, how would you do it?
destroy the building.
Right, destroy the building and start over. Yeah, that's one way. But suppose you were kind of happy with the building.
Estimate the value of the land and the cost of the
Right, so you could do an appraisal for one or the other, or you could do something arbitrary. In the US, it tends to be arbitrary, depending where you are. If you're in like Las Vegas, oftentimes the land has the bulk of the value, mostly because you're about to destroy whatever's there and build something newer. If you're in a suburb, maybe the building has the bulk of the value. And if you're in a rural community, the land usually has very little value. So you might go from 95% land to 10% land value to where you are. But it tends to be an arbitrary allocation of one purchase price. What would you have under equipment?
Fleet vehicles.
Well, vehicles would be down here under vehicles.
Interesting.
big printer or something.
A big printer, okay? How would you differentiate machinery from equipment? Let's say you're a company and you have a category for equipment and a category for machinery. What might you put in one versus the other?
Machinery related to the manufacturing.
Okay, so if they had a factory, you know, manufacturing, things involved in the manufacturing process would be machinery. What would be under equipment?
Laptop also. Can we?
Laptop, I'd probably put under computers. I had that.
Equipment's material to move. Equipment is to move material. Machinery is to manufacture material.
Okay, so you would put maybe a forklift, one of those things that lift pallets.
Yes, pallet jack, yep.
Okay, that's possible. I was thinking more about office equipment, copier, photocopier type of thing. So plant versus office.
This,
As in,
anything.
but generally, a lot of people might interchange machinery and equipment. Anything under machinery you could think about as being equipment as well. Natural resources we'll skip. How about land improvements? What would you have in land improvements?
Expansion.
Parking lots, sidewalks. Oh, okay. Yeah, generally, the book is right. Parking lots, sidewalks, lighting, fencing, things that go on the land that are not attached to the building that have their own depreciable life. Furniture could be chairs, desks. Fixtures, if you have a retail establishment, it might be the racks you display clothes on or the shelves you have merchandise on. Computers, depending on the nature of your business, could be subdivided. I had a client that had separate accounts for computers, peripherals, servers, and laptops, because they were each substantial and different, and they wanted to keep track by category. What do all of these, and we'll just take off natural resources for the time being. What do all these items have in common?
They all cost money.
They all cost a lot of money. What else?
Their use extend beyond 1 year.
Their life is greater than 1 year. One more consideration.
Will be essential for any company.
Essential, it's getting there, but the essentiality isn't actually what we're looking for.
They can be sold.
No,
Transferable.
no, not transferable.
Normal use goes to generate.
It has to be used in the operation of the business. It can't be held for resale, and it must be used in the operation of the business. When we record fixed assets, we record them initially at cost. And the cost includes all the elements necessary to get the item ready for use. Purchase price, sales tax, delivery, installation, testing. So whatever is involved. Now, some of these items may have different things necessary to get it ready. When we say purchase price, sales tax, delivery, we're not talking about the building. We'd be talking about equipment, machinery. If we're talking about a building, it would be the purchase price, it would be legal fees, it would be closing costs. In some cases, it might include, as part of the cost of the land, knocking down a building. The raising part of the building might be a cost that's added to the land value. So it all depends what it takes to get the item ready for its intended use. Those all get capitalized as one number as part of the cost. Any questions about that? Sometimes you have what's known as a basket purchase. It's the concept of paying one price for land and building, but it's applied to something different. We could apply it to the land and building, or we could apply it to any time we buy a bunch of different items together for one price. So let's say we get 3 pieces of equipment. And together we pay $100,000. And for some reason, we need to know how much of that $100,000 is allocated to each of those 3. They're 3 different things. How would we go about doing it?
Sometimes it depends. You can actually look at the allocation in terms of square feet or size, but then
For the equipment, you would use square feet or size?
no, I said it depends. Let me see.
We need estimated values for each of the 3 pieces of equipment.
Estimated values, that could work.
Professional valuation.
Appraisal,
Yeah.
estimated resale value or estimated used value. So some estimate of value is probably going to work best. Now, what we're doing here on the basket purchase comes up numerous times in accounting. The idea of one price buying different items and we have to allocate the price is common. You're going to see that multiple times. Not always using the same basis as this, but the concept's always the same. We need some way to allocate, and generally it's not going to be a third, a third, a third. So in this case, we're going to use the fair market value approach or the relative sales value approach. So let's call it fair market value. So for each item, we have to figure out what the value is. We might do an appraisal, we might look on eBay, we might call a broker, somehow we'll get an estimate of the value. I'll change this one to 20. No, let's leave it like that. 30, make this one 40. So let's say the value of the first piece of equipment is $30,000, the value of the second is $40,000, and the value of the third is $50,000. Together, that totals $120,000. So we got a good deal. And generally, we expect the value to be greater than what we paid. Otherwise, we wouldn't have bought it as a basket. We would have purchased them individually. You ever go to a store and the price is 4 for $1 and they're 20 cents each? Well, why would you ever buy 4 for $1 and they're 20 cents each? You would just buy 4 separate ones and pay 80 cents. So generally, the basket price is going to be less than the individual values. So to allocate the 100,000, we figure out the relative percentage. So we take the individual value divided by the total value, total market value for all 3. What's 50,000 over 120,000 gonna be? Roughly 42%, right? So it should be, I mean, we could figure it out and divide it, but it should be the difference between 100% and what we have here. So 41 2/3%. Then, if we take the 100,000 times that percentage, we'll get the cost allocated to each of the three items. And hopefully, if we add it up, it adds back up to the 100,000. So any questions about the basket purchase?
At what point do you use the fair market value instead of the actual cost on the balance sheet?
Well, in this case, we've paid 100,000 and we've gotten three things. If we wanted to record them all together as one, we would just call it 100,000. But with the basket purchase, we need to record them individually. So we would debit equipment 1, 25,000, debit equipment 2, 33,333, debit equipment 3, 41,667, credit cash 100,000. We bought them individually, whatever we paid for it is what we recorded at. Then if we paid anything else, like for delivery or installation, we would also record that as part of the cost of the asset. So we would always want to use the cost. We would never use an arbitrary fair market value that we didn't pay for. So if we bought something we paid 100,000, but its fair market value was 120, we would record it at 100,000.
Where I'm thinking is that sometimes companies do revaluation of their assets.
Not the fixed assets.
Or is that a fixed asset?
Fixed assets.
Balance sheet.
If you have investments, you could use a fair value. You could do that for investments. You could do it for liabilities. Can't do it for fixed assets. You don't revalue your land, property, and equipment. Otherwise, people would forever be doing it. Now the fun begins. Depreciation. What is depreciation?
It's the amortization of the asset over its lifespan.
It's the,
Amortization of the asset over its lifespan.
that's correct. Usually the answer I get is it's a process that shows the value of the asset is decreasing. And that's actually not the case. And in some cases, values increase, but that doesn't affect depreciation. Remember we talked about the matching principle. Matching principle takes expenses and matches it to the revenue they produce. By definition, all these assets are used in the operation of the business. Therefore, they're producing revenues. And because they last over a year, they're producing revenue into the future. So depreciation is the allocation of the cost of the asset to the periods of benefit. And in order to do depreciation, we need a couple of items. We need the cost, we need the method, and we need the life. I'll also throw in something called salvage value. So let's pick anything. Let's take a piece of equipment that cost $100,000. How long will this equipment last? 5 years. Could be 7 years, could be 10 years, could be 5 years. At the end of 5 years, what will its value be? You want to say zero? Well, let's make up a number just because it's easy to illustrate with it. 20,000? 20,000? Okay. Now, zero is actually more realistic because in all my life, the only time I've ever seen salvage value is in an accounting class. I'm not saying nobody uses salvage value. I'm just saying I've never seen it. Most of the time you should. How many people own a car? How old is the oldest car? Anybody's car 10 years old? 20 years old? So it's 10 years old. It has some value now. In another 10 years, what do you think its value will be? Nothing. Well, here's the unwritten rule. Somebody's always willing to pay $500 for any car, no matter what it is or how old or how many miles or what condition. Generally, cars always have some value. Now, to us, it really may not be worth anything, but generally somebody's willing to pay something for almost anything. But yet I've never seen salvage. Now we need a method. What are some of the methods that you've heard of?
Straight line depreciation.
Straight line. Okay. How about another method?
Declining balance.
Declining balance. Another method.
Activity based.
Some of the
Sum of the year's digits. And one more method, not applicable to this particular piece of equipment, but you will see it. It's called an activity method. So we're going to use the information for this piece of equipment to depreciate it by each of the first three methods. Straight line's the simplest. It's the cost minus the salvage value over the life. It's 100,000 minus 20,000 over 5. So 80,000 over 5 is 16,000 a year. So every year we would debit depreciation expense, 16,000. We would credit equipment hyphen accumulated depreciation hyphen equipment. Each grouping of asset has its own accumulated depreciation account. If we had buildings, fixtures, equipment, and vehicles, we'd have accumulated depreciation hyphen building, accumulated depreciation hyphen equipment, accumulated depreciation hyphen vehicles, and so on. Each one gets its own. There's only one depreciation expense, but the accumulated depreciation is by asset type. Declining balance depends on the type of declining balance. The common declining balances are 125%, 150%, 175%, and 200%. 200% is known as double declining balance. or DDB. And how does that work? Well, you start off with the useful life. What's the useful life of this asset? 5 years.
5 years.
And we turn that into a percentage. If it lasts 5 years, it means each year we take 1/5 of its value. How much is 1/5 as a percentage?
20%.
20%. That's called the straight line rate. Now we adjust the straight line rate by whichever declining balance method we're using. So let's say we're using double declining balance,
40%.
40%. Suppose we were using 150% declining balance. It would be 20% times 150% or 30%. So whatever the percentage we're using, 125%, 150%, 175, 200, we times the straight line rate by that. And it gives us the percentage we're going to use. With double declining balance or any of the declining balance methods, we don't subtract salvage value. So the first year's depreciation is 100,000 times 40%. First year depreciation is 40,000. And we keep track of the balance left to be depreciated. It had a starting value of 100,000. We've taken 40,000 in depreciation. That leaves a balance to be depreciated of 60,000. So in year 2, we do 60,000 times 40%. That equals 24,000. So at the end of year 2, how much is left to be depreciated? 36. In year 3, we have the balance to be depreciated of 36,000 times 40%. So how much depreciation do we take?
14,400.
14,400, leaving how much to be depreciated? $21,600. How much depreciation do we take in year 4? It's a trick question. It's 1,600. The number in this column should never be lower than the salvage value. We didn't adjust the cost, the 100,000, by the salvage value. So we have to keep track of how much depreciation we take. We can't take more than $80,000 in depreciation because that would leave the book value, the cost minus the accumulated depreciation, less than 20. And we don't want to do that. We only want to take 80,000 in depreciation. So the balance should never be less than 20,000 in this case. That means in the last year, there's only $1,600 of depreciation to take. It's not the calculation. If we just kept doing this for 5 years, we could get very close to taking all of it in depreciation. We won't get to 0 for book value, but we don't want to get less than 80,000, other than 20,000. You can
We must keep 20% of the cost.
Well, in this case, we didn't define it as 20%. We just said 20,000. Right? We said salvage value is 20,000. That was your number, wasn't it? And you picked 20,000?
His number.
His number. Okay, sorry. So we said salvage value is 20,000. So that means the book value is cost minus accumulated depreciation, should never be less than 20,000. So in this case, we only had a little bit of depreciation left to take before the book value was down to 20,000. Any questions about declining balance? Some of the year's digits. I've been told that there are some companies that use it. I have never actually seen it in practice. What do we have to do? You make a list starting with 1, then count up to the number of years. So this asset has a 5-year life. So we put down the numbers 1, 2, 3, 4, 5. Then we add them together. We get 15. Those are the sum of the years' digits, 15. Then we take how many years left. So for a 5-year asset, in the first year, how many years are left? It's going to be 5. So we take 5 over 15, times the cost minus the salvage value. In year 2, we take 4/15. In year 3, 3/15. Year 2, 2/15. Year 5, 1/15. So the numerator is the years left. The denominator is the sum of the years. So 5/15 is 1/3. 1/3 times 80,000. Like 26.4. I don't know, what is it? 26.6? Wasn't too far off. 26,666. Then 4/15 times 80,000. Let's see, is that going to be 21,333?
Yeah.
Yeah.
And so on. Any questions about some of the year's digits? Okay, for the activity method, we need different information. Piece of machinery costs $250,000. Over its life, it's expected to produce 100,000 units. Year 1, it produces 20,000 units. Year 2, 30,000. Year 3, 25,000. And salvage value is 50,000. So how much depreciation do we take in year one? Well, it's going to produce a total of 100,000 units. So in year one, we produce 20. So we've used up 20% of its life in year one, 20,000 over 100. And we'll times that by 250 minus the 50,000 in salvage. So we'll times it by 200,000.
What was that again? Year one was calculation?
We produced 20,000 units in year one. It's going to produce 100,000 over its life. So we've used up 20% of its value. So that 20%, 20,000 over 100,000 units all times by the cost minus the salvage value. Year two, we have 30,000 over 100,000 times the 250 minus the 50. So that's going to be 60,000. In year three, we have 25,000 over 100,000 times the cost minus the salvage. Nope, it's 50,000. 50.
What
And
is
that's
that
how-
last number over there? Is
So-
that 625,000?
This?
Yeah.
Yeah, 25,000 over 100. Now, units of activity is used a lot in certain industries. If you're an airline, your plane usage is based upon hours of flight. So you'll usually depreciate as well as service based on how many hours of flight a plane has had. Sometimes you'll see it in production like this, but most of the time not. Any questions about the depreciation method? So we have an asset that costs $200,000. Estimated salvage is $10,000. Its life is 10 years. It's expected to produce 100,000 units over its life. In year one, it produces 10,000. In year two, 15,000. Year three, 20,000. Using straight line, double declining balance, sum of the year's digits, and an activity method, figure out the depreciation in each of the first 3 years.
Can you repeat the last part of the question?
You have to figure out depreciation expense using each of those 4 methods for 3 years, each of the first 3 years.
balance, use for declining balance,
What's this double declining balance?
double declining.
Double.
All right, see how we did. Straight line, year one. How much depreciation do we take?
How nice and thousand.
200,000 minus 10,000 over 10 equals 190,000 over 10. 19,000. At the end of year one, the entry is debit depreciation expense. Credit accumulated depreciation hyphen whatever type of fixed asset this is, 19,000. How about year two?
28,500.
28.5. Anything else? Any other choices?
The same straight line?
Yeah.
So it would be 19,000.
19,000. It's the same amount every year. So year three, 19.
Same.
And the journal entry will be the same. Debit depreciation expense, credit accumulated depreciation. So the T account for accumulated depreciation is increasing by 19 each year. But the amount of depreciation we take each year is the same.
What is that depreciation expense?
Depreciation expense, 19,000. Accumulated depreciation, 19,000. Any questions about straight line? Double declining balance, year one. How much depreciation do we take? 40,000, let's say. It has a 10-year life, so the straight line rate is 1/10 every year, equals 10%. We double that for double declining balance, and we get 20%. 20% times 200,000 is 40,000. So the entry would be debit depreciation expense 40,000, credit accumulated depreciation 40,000. How much depreciation do we take in year two?
32,000.
we had a cost of 200,000 minus accumulated depreciation, which is how much depreciation we've taken, which is 40,000, which we took in year one, gives us a book value of 160,000 times 20%. Gives us 32,000 in depreciation in year two. How about year three? Well, the cost is the same. How much is the accumulated depreciation?
72.
The 40 plus the 32 or 72. So how much is the book value?
120.
128 times 20% is
25.6.
25.6.
Can you repeat that, please? I missed it.
For year three,
Yes.
so the cost was 200,000. The depreciation we've taken to date is the depreciation we've taken in the first 2 years of 40 plus 32 is 72. That means the book value is 128,000. That 128 times the 20% equals 25.6, which is the depreciation we'll take in year three.
Thank you.
Any questions about double declining balance? Sum of the year's digits. Now, I always start out with 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. If we add that up, what are we going to get? 55. How did you get that? Did you add up 10 plus 9 plus 8?
No.
Suppose it was a 100-year life. Now what does it add up to? It adds up to 5,050. How do I know? What's 100 plus 1?
101.
What's 99 plus 2?
101.
What's 98 plus 3?
101.
How many pairs like that are there?
50.
Do you expect us to remember that?
Well, it's the same thing here. 10 plus 1 is 11,
That's easy.
and there are 5 pairs. The only time that doesn't work that evenly is if there's an odd number. You could do it, then you got the middle, or you could do it except for the last number, and whatever you get, add the last number. Generally, it's a lot easier than 10 plus 9 plus 8 plus 7, which isn't so bad, but if you're doing 40 years, which happens with buildings, 40 plus 39 plus 38, it just could be tedious. You could also use factorial, but I like that method.
Sorry, Mr. Where did the 50 come from?
There are 50 pairs.
Uh,
We're taking 2 numbers at a time, and there's 50 pairs. So we get 55. So year 1 is going to be 10/55 times 200 minus 10. 34, 5, 4, 5?
Yes.
So 10/55 is 2/11. 2/11 is roughly 22%. 22% times 190,000. Is that right?
What is that?
55 times 190,000. 34.5. Yeah, so it's a little less than 20%.
200 times.
200,000 minus 10,000. The cost minus the salvage. Then year 2, it's 9/55 times 200,000 minus 10,000.
31,090.
31,090. 31,090. And year 3, 8/55 times 200 minus 10,000.
27,636.
27,636. Any questions about some of the year's digits? Then we have the activity method. And I'll show you 2 ways to do the activity method. The first way is the way we've illustrated it before. So the amount we're going to depreciate is 200,000 minus 10,000. And we're going to times that by a ratio of how many units were produced in the year over how many total units are going to be produced. So how much depreciation do we take in year 1? 19,000. In year 2, the ratio was 15,000 over 100,000 times 200 minus 10,000. So how much depreciation do we take in year 2?
28,500.
What? I'm sorry. Why is it 100,000 and not 200,000? The value is 200.
The value is 200. The
Units.
quantity it's going to produce is 100. And in year 3, we have 20,000 over 100,000 times 200,000 minus 10,000 equals
38.
The other way to do the activity method is to say the amount we're going to depreciate is 200,000 minus 10,000 or 190,000. How many units are going to be produced over the life of this asset? So if we take the total we're going to depreciate and divide by the total units, we get depreciation of $1.90 per unit completed. So in the first year, how many units did they complete? 10,000 times $1.90 is how much? 19,000. Year 2, they completed 15,000 units times $1.90 equals how much?
on Bang is 28.5. And in year 3, it was 20,000 units times $1.90 for 38,000.
Either method should produce the same answer. You just pick whichever one you're comfortable using. Any questions about the activity method? Intangible assets. So when we have the balance sheet, we have current assets, cash, accounts receivable, prepaid expenses, etc. Then we have fixed assets. Then we have intangible assets. What are the type of items that fall under intangible assets?
Patent.
Patents?
Patent.
Copyright.
Patents. What else?
Goodwill.
Goodwill.
Trademark.
Trademark.
Copyright.
Big names. Copyright. One more common one.
Franchise.
Franchises. Now, these are similar to fixed assets. They last longer than a year. They're used in the operation of the business to produce revenue. Only they lack physical substance. What are these really? These are legal rights. And we group them under intangibles. Now, we're going to come up with some way to allocate the cost to the period of benefit, except we're not going to call it depreciation. What are we going to call it? Amortization. So instead of depreciation expense, it's going to be amortization expense, and the credit is not going to go to an accumulated amortization account. The credit is going to go into whatever it is. It's going to credit patents or credit copyrights or credit trademarks. Let's talk about what this is. What is a patent?
It's like a logo. No, I'm mixing this with trademarks. Sorry.
Patent is protection for the right to produce something. I'm going to summarize and give you not the full legal definition, but the layman's working definition. The right to produce something for a period of time. How long is a patent good for?
20 years.
Not 10 years. 20 years. 20 years. So some things you get patented, some things you don't. Most drugs are patented. That means from the time the patent is granted, the company has 20 years of protection. Sometimes the patent is granted 5 years into the life of the item, so maybe they have 15 years of protection. But generally, drug companies get patents so that no one else can make a generic version of the drug for the period of protection. Some things don't get patented. The formula for Coca-Cola, the formula for Kentucky Fried Chicken, they don't get patented because at the end of 20 years, or when patent first started, maybe 17 years, the formula would become public and anybody could copy it. The patent for the formula for Domino's Pizza isn't patented. Only because no one ever wants that formula, so they don't have to worry, they don't need it. But things you want to keep protected forever, you make a trade secret. At the end of 20 years, formulas, patents become public domain. Anybody could copy it. Goodwill is a little different. And in essence, it's a plug figure to balance a journal entry. So if you buy a company and you get their assets, so the assets you get total 100,000, and you incur some of their liabilities. The liabilities you incur are 40,000. Plus you've paid 80,000 to acquire that company. So you record the assets, you record the liabilities, you record what you paid. It's out of balance. In order to balance, you need to debit something for 20,000. And that's called goodwill. Goodwill is the excess over the net assets plus the cash you paid to acquire the company. Why do you have goodwill? Sometimes companies have things that don't show up on the balance sheet. A great location, terrific staff, a well-known name. A lot of these things may have value but aren't part of the assets. So you're willing to pay for it. You're willing to pay not to have to start over and build a business. So that's called goodwill. Trademarks and trade names. What's a famous trademark?
Coca-Cola.
McDonald's Orchard.
You say Coca-Cola, a trade name?
That's not a trademark. That's a trade name. So what's Coca-Cola's trademark? Their logo, the way they spell Coca-Cola. If I said the Golden Arches, what would you think of?
McDonald's.
McDonald's, that's right. Any recognizable trademark has value. Even sometimes more valuable are trade names. Or if I showed you an apple with a bite out of it, what company is that? It's kind of apple with a bite out. It's kind of easy. You get the idea. You can just turn around and see. You know exactly what it is. Trade names are very interesting. You're probably too young to remember this. But a number of years ago, there was a commercial campaign on TV. And it was for Brand-Aid brand adhesive strips. Anybody remember seeing that commercial? It ran for a while. And why did they have a commercial with a tagline that sounds so clumsy? Brand-Aid band adhesive strips. Because if you had a cut and you needed to put something on it, what would you put on it? You'd always say, I need a Band-Aid. The name Band-Aid is the brand name. It belongs to the company. I think it's Johnson & Johnson. And it was becoming so popular that it was about to be accepted as a generic term for adhesive strip. And they didn't want everybody to be able to call their product Band-Aid. That was their specific trade name. So they were trying to re-emphasize that it's a brand name, not a generic product. And we've seen that. When your lips are chapped, you have a little tube. What do you put on it?
Chapstick.
Yeah, that's the wrong kind of tube. This is like a little jar.
Vaseline.
Vaseline, right. Actually, it's petroleum jelly. Vaseline is the brand name. When you sneeze, what do you get?
Kleenex.
Right, that's the brand name. It's actually a tissue. The Florin, not so much anymore since we're out of the 60s and 70s, but linoleum. Linoleum is the brand name. Vinyl tile is the generic product. A lot of these things, and you could probably think of some on your own, have gotten so popular as brand names that everybody just refers to it.
It used to be when you wanted to make a photocopy, you called it the Xerox. Well, Xerox is the particular company that made a photocopier. The generic name is Photocop. And so a lot of these companies want to protect trade names. How long is a trademark or a trade name good for?
Forever?
It's forever as long as you keep renewing it. So you can have this forever. What's a copyright? A book, written material, compose, a musical number. And how long is a copyright good for? No, it's not forever.
The life of the creator
Musical
plus
rights
7
are
years.
75 years after someone dies.
Life of creator plus 70 years. So what happens at the end? So let's take Beethoven, Mozart, Da Vinci. You can take any of their works and use it freely. That's why people can make copies of the Mona Lisa and do whatever they want to it, not have to pay royalties or get permission. We're past the life of the creator plus 70 years. Things within that band, you either have to pay royalties and or get permission to use. It's not available in the public domain. What are franchises?
Name of the company, you will like use it in another country.
So it's a popular name that you could use their formula. In fact, you have a franchise, most of the time you have to use their formula, they have to use their name, you have to use their packaging, you have to use their advertising. So it's a right to use developed product in a particular market. And so you're going to pay an upfront fee plus usually a percentage of revenues to the company. Now, think of a couple of companies that operate as franchises.
Dunkin' Donuts.
Dunkin' Donuts. Any others?
McDonald's.
McDonald's. Now, both of them, especially Dunkin' Donuts, have what's known as company stores and franchises. And you don't really know which is which, unless you ask, is this, or if it had a little sign that says this is a franchise operated by, you can't be sure. Some only have franchises, and some only have company stores. Anybody ever go out west to a burger place called In-N-Out Burger?
Yes.
You like it?
Yeah.
Pretty good, isn't it?
Yeah.
Really good. Those are not franchises. Those are all company owned. Family owns all of them. And the problem with that is you can't expand too much. Because if you want to always be in control and manage it, you have to have it close enough of the size you can handle. So they go from California, I think the furthest east might be Texas. I don't know of any further east. So it's not a bad geography, but you're not going to be in every country all over the world like you can with a franchise. The downside is we've all been in a McDonald's that isn't particularly well run. We've been in Dunkin' Donuts that isn't as good as some others. It's harder to have quality control as much as you want it when you have all these different people operating. So franchises, a little different than these other items. Franchises is good. They last as long as the agreement. Usually they're renewable if you're doing a good job. We amortize over the lesser of the economic or legal life. So if we think the economic life of a patent is 10 years and there's still 15 years to run on it, we would use 10 years to amortize. The lesser of the legal or economic life, for something like a trademark or a trade name, which is indefinite as long as it's renewed, we wouldn't amortize. Let's talk about the value on the balance sheet. Apple, tremendously valuable logo and trade name. What do you think it's on their balance sheet for? How much money? How many people say more than $1 billion?
Yeah.
Nobody. More than $1,000.
Definitely.
200,000. 500,000. No, the truth is, I don't know. But what's on the balance sheet isn't the value of it. Value does not get put on the balance sheet. What is on the balance sheet is the cost to create it, if they paid a designer to develop it, and the cost of the legal fees in filing, and the cost of defending lawsuits for people that infringe on their trademark or trade name. Not the value. If I were to buy the logo from Apple and paid them for it, I'd pay a huge amount of money. That would be what I would put on my balance sheet, because that's what I paid for it. Not its value, but its cost. So if you buy it, it's going to be a much greater value on your balance sheet than if you develop it yourself. Now, everybody knows about luxury handbags, Louis Vuitton, Gucci. Those, most of the value for their trademark and trade names on their balance sheet are legal fees in defending against knockoffs. If they pay someone a large amount of money to come up with a new design, and some of them do that, that could be put on their balance sheet. Any questions about intangibles?
So you said for the balance sheet, you include the cost to create, the cost of legal fees, and what was the other one?
Defend it. Legal fees to file, and then the legal fees to defend. One item we'll just mention that we won't spend a lot of time on that greatly affects depreciation. And that's when we were doing depreciation, what assumption were we making inherently? Well, if we took a full year of depreciation the first year, it means the acquisition date was January 1st. How often do you think you buy assets on January 1st? How many people work January 1st? Probably not a lot. And most people may not buy assets at the beginning of the year. They may buy them when they need them, which could happen at any time. So let's say we bought an asset on April 1st, and we used the calendar year. For the first year, we would be able to take 75% of the depreciation because it's 75% of the year. The next year, we could take 100%, 100%, 100%. Then at the end, it'd be 25% in the last year. So we may have to prorate the first year's depreciation and the last year's because we didn't buy it January 1st. Won't be on the test, just something to keep in mind. Don't assume that everybody always takes a full year's depreciation the first year. Depends on the acquisition date. To make things easier, some companies use what's known as a convention. The convention says during the first year, no matter when we buy it, we'll take a half year's depreciation. This way we don't have to count days. If we buy it January 5th, we take a half year. If we buy it December 30th, we take a half year. And we'll just always apply that convention. Another concept that's fairly important. Most people have a car? Or has seen a car? Ridden in a car? Sometimes we spend money on our cars. Sometimes the money we spend is added to the cost of the car, and sometimes it's just a normal maintenance expense. So if we put windshield wipers on the car, normal maintenance expense. New air filter, normal maintenance expense. How about tires? Normal maintenance expense or added to the value, to the cost of the car?
be a company car you're talking about, or just a regular car?
Well, cars,
Added value, would that be an added value? I don't know.
well, it's gonna last longer than a year. Does it cost enough?
No.
Maybe, if we're talking about certain large manufacturing vehicles built by Caterpillar with these $100,000 tires, that would be different. If we're driving into Mavis and buying a set of 4 all-weather radials and they're, $80 a tire, probably it's a maintenance item. How about a new engine? New engine's probably going to be added to the cost. Why? Because it's going to extend the life of the car. You got to replace the tires to keep the car running, but it really doesn't extend the life of the car. An engine will extend the life of the car. It has to be sizable and it has to change the remaining useful life in order to be capitalized. The last item is getting rid of a fixed asset. So let's say we have a piece of equipment. Cost is $100,000. Salvage is $20,000. Has a 5-year life. We sell it in year 3 for $40,000. What's the journal entry? Now let's put some dates down. So we purchased it January 1st, 2012. We sell it July 1, 2014 for $40,000. What's the journal entry? So here's the procedure. We record, because most of the time we record depreciation at the end of the year. In the year we sell it, we may not be at the end of the year. So the first thing we do is record depreciation to the date of sale. Then we debit accumulated depreciation. We credit the cost of the asset. We debit whatever we receive. And then we balance the entry. If we need a debit to balance, it's a loss. If we need a credit to balance, it's a gain. So in this case, how much depreciation will we take each year? Assuming straight line.
16.
We will take $16,000 a year in depreciation. It's $100,000 minus $20,000 over 5 years. So in 2012, we take $16,000 in depreciation. In 2013, we take $16,000 in depreciation. Now we're in 2014, and we sell the asset. So we take depreciation to the date of sale. How much depreciation will we take? We sell it on July 1st, so we're going to take half a year, which is 8,000. So we have accumulated depreciation at the date of sale of 40,000. So step one, record depreciation to date of sale, which we did. Now we make the journal entry. Debit accumulated depreciation, that's going to be 40,000. Credit the cost of the asset, that's 100,000. Debit whatever we received. We received cash of 40,000. So what do we need to balance? We need a debit for 20,000. So what are we going to call that? Loss on sale of asset. Now we would have known we're going to have a loss because the book value was the cost minus the accumulated depreciation. So the book value was 60,000. If we sell it for less than 60,000, we're going to have a loss. If we sell it for more than 60,000, we're going to have a gain. We sold it for 40, so how much of a loss are we going to have? It's going to be 60 minus 40. So if you just have a straight sale of a depreciable asset and follow these steps, you'll always get the right answer. Any question on what to do when you sell an asset? Taking a selfie? Okay, we ready for the homework? See, so we had 1, 2, 3, 5, 8, 9, 11. Chapter 7. Exercise 1. Company purchased a tract of land in an existing building for $1 million. The company plans to remove the old building and construct a new restaurant on the site. In addition to the purchase price, they pay closing costs, including title insurance of $3,000. They also pay $14,000 in property taxes, which includes $9,000 of back taxes and $5,000 for the current fiscal year. After the purchase date, shortly after closing, they pay the contractor $50,000 to tear down the old building and remove it from the site. They're able to sell salvage materials from the old building for $5,000, additional $11,000 to level the land. How much should they record as cost of the land? Throw some numbers out. Okay. So let's see. Purchases an existing building for $1 million. Is that part of the cost of the land?
Yeah.
Well, what about the building on it? Should we allocate that to the building? Can you hear the hand dryer at home?
Yeah.
You can?
Yes. Yeah, you can.
Yes.
Yeah.
Yes.
So what happened? You can't appreciate this, but there was a class in here now that today's the first day of the undergraduate semester. So there was a class in here until they were supposed to get out at 6:18. They left at 6:25, and they left a stink in the room. So we had the door open, and there's a girls' bathroom right across the way. And every time they use the hand dryer, it keeps running when they leave. So every time they open the door, you really hear it. We'll close the door and see if it's better. See if we can live with the smell. However much time we have left. So the $1 million we don't have to allocate because they're tearing down the building. Because it's not like 5 years into it and they changed the building. The plan was never to use that building. The whole cost is related to the land. Closing costs, which include title insurance, that gets included. They pay $14,000 in property taxes. Now we have to see why. When you buy something, you often have an adjustment for the year's taxes. That's tax expense, not a cost of the building or the land. But there were back taxes.
9,000.
The $9,000 is part of the capitalized cost of the land. $5,000 would just be tax expense for the year. The contractor tears down the building, that's $50,000. That counts. They get $5,000 for salvage materials. That's an offset to their cost. So we reduce the cost of the land by the $5,000, and the leveling gets added to the cost of the land. So my calculations says 1262.57, $1,068,000. Exercise 2. Company purchases a new machine and they had the following expenditures: purchase price, sales tax, shipping, insurance for the first year, and installation. So let's put all those down. 75. Is the purchase price part of the cost of the machine?
Yes.
Sales tax,
Yes.
shipping,
Yes.
insurance,
No.
installation.
Yes.
Okay, so we agree that insurance is not part of the cost of getting the machine ready for use. It's part of the operating cost of having the machine. The other items would be capitalized as part of machine. Exercise 3, we get the basket purchase. They purchase land, building, and equipment for a total price of $600,000. The fair values are land, 175, building, 455, equipment 70, for a total fair value of 700,000. So how do we allocate the purchase price to the sum of the fair values? We take the relative fair value percentage each of those are. So it's 175 over 700, 455 over 700, and 70 over 700. What's 175 over 700?
25%.
25%?
Yes.
And so that makes 455 over 700, 65?
Yes.
Always like to add it up to make sure I got 100%. Now we take the percentages and times it by the 600,000. 25% times 600,000 is 150. 10% is 60. So 65% times 60 should be
390.
390.
Yes.
We add it up, we should get 600,000. Any question about the basket purchase in exercise 3?
No.
Then we had exercise 5. Attorney's fees of 9. Purchase a patent of 40. Legal and other fees related to the patent, 2,500. Pre-opening salaries, 80,000. What do we record each of these items as? So the attorney's fees of 9,000 to organize the corporation. Where would you charge them?
Part of the foundation expense.
So you would call it organization expense, legal fees. Generally, I would probably call it legal fees, legal expense. As opposed to an organizational expense. Years ago, we used to call it organizational expense. We've gotten away from that. Purchase a patent for 40,000. What would you call that? Patent.
Okay.
Where would you put the legal fees to acquire the patent? No, that would go to the patent. They're part of the acquisition of the patent. And the pre-opening salaries. I call that salary expense. Some people might differ with some of these, but that's where I would put them. 8. Matching. You won't see this on a test. Listed below are several terms and phrases. Pair each. So let's start with the right side. List BA. Exclusive right to display a word, a symbol, or an emblem. Trademark. Exclusive right to benefit from a creative work. Copyright. Assets that represent contractual rights.
intangible assets.
Intangible assets. Oil and gas deposits, timber tracts, and mineral deposits.
Natural resources.
Natural resources. Purchase price less fair value of net identifiable assets. Exactly. Goodwill. The allocation of costs for plant and equipment. Allocation of the cost of the asset to the period of benefit for fixed assets.
Depreciation.
Depreciation.
Depreciation. The allocation of cost for intangible assets.
Amortization.
Amortization. Sub Sandwiches of America made the following expenditures. Indicate the amount they should debit for each of these. Replace the heating equipment at a cost of $250,000. Where would you put that? Equipment. So I would agree. I would call it equipment, and I would depreciate it over whatever life I thought the heating equipment has. Covered the patio area with a clear plastic dome, enclosed it with glass. Total cost $750,000. What would you call that?
Building.
Is it really a building?
That's what happened in the answers, but that's what I know. If it's increasing the value, the longevity of the asset or improving it, then would it be? Because that's what it's calling it. That's what it's interpreting it as.
Well, I think it would be a fixed asset. The question is, would I call it building?
What is this?
Covered the patio area with a clear plastic dome and enclosed it with glass for use during the winter months. If it's an extension of the building, then I could see calling it a building. If it's a separate freestanding structure, I might call it a land improvement. The idea is it is a fixed asset, it's just a question of what we're gonna call it. Performed annual building maintenance at a cost of $24,000. Maintenance expense. Paid for annual insurance of $8,800. Either insurance expense or set it up as a prepaid, but we wouldn't add it to the cost of the facility. Built a new sign above the restaurant, putting the company name in bright neon lights for $9,900. I call it sign and depreciate it over the sign's useful life. At one point, I used to own laundromats. And one of the laundromats I owned was in a freestanding building, which I also owned. And on the building, of course, was a big sign with the name of the laundromat. And I had two companies, one owned the laundromat, one owned the building. So when I was selling it, you could either buy them together or buy it separately. If you didn't want the building, I'd keep the building and you buy the laundromat. If you wanted both, you could buy both. But of course, the price was different. The sign belonged to the laundromat, just happened to be on the building. Like the laundromat was in the building. So there was one particular buyer who wanted to pay me just the cost of the laundromat, but get the building also. I said, no, it doesn't work like that. The building's one price, the laundromat's another price. If you want both, add them together. She said she spoke to her accountant, and the accountant said because because the sign comes with the laundromat, that means you get the building too.
So you get the building of shopping center.
Exactly. So,
Should fire her.
well, it didn't fire, I just didn't sell to her and I threw her out. Trying to make them understand that the sign belongs to the laundromat, but you don't get the building because you bought the sign. Paved a gravel parking lot at a cost of $65,000. This one should be clear and easy.
Land improvement.
Parking lot was one of the examples we used.
Land
Land
improvement.
improvement, yes. And then the last one we had was 11. Speedy Delivery purchases a delivery van for $36,000. Estimates salvage of 6,400. What's the useful life? 4 years. 4 year service life. Life is 4 years. And it's expected to go 148,000 miles in those 4 years. Calculate annual depreciation for the first 2 years using each of the following methods. And the miles driven in year 1 was 40,000. And in year 2, 46,000. So we have to do straight line, double declining balance, and activity based. So how much depreciation do we take in year 1 using straight line? We have a cost, 36,000. Salvage of 64. That's going to be over 4. That equals 29,600 over 4 equals how much?
7,400.
7,400. And that's for year 1. How much in year 2?
The same.
The same. Any questions about straight line? Double declining balance. First, we need to get the straight line rate. 4 year life, so 1/4 is 25%. It's double declining balance, so we're going to double 25% and get 50%. So depreciation in year 1 is 36,000 times 50% equals 18,000. In year 2, it's 36,000 minus the depreciation taken of 18.
9,000.
Or 18,000 times 50% equals 9,000. What would it be in year 3? Total depreciation taken is 27. So 36 minus 27 is 9. 9 times 50% is 4,500.
Do you restrict it to the salvage value?
Double declining balance doesn't include salvage value in the calculation. We just make sure we don't depreciate it below the book value. So the most depreciation we could take on it is 29,600. The difference between the cost and the salvage. So when this gets up to 29,600, we have to stop depreciating. And then we have the activity method. So we have depreciation to be taken of 29,600, the cost of 36 minus the salvage of 64. In year 1, we have 40,000 over 148,000, which equals what percent?
.20.
How much?
0.20.
0.20? 20%?
27.
27%.
It's 0.20.
It can't be 0.20.
That's 27.
So 27% times 29.6 is how much? Even? 8,000 even. Okay? And then in year 2, it's 29.6 times 46,000 over 148,000. What's 46 over 148? $31. So 31% times 29.6 is how much? $9,200. Now the other way to do it is to take 29.6, the amount we're going to depreciate, and divide that by 148,000 miles, which is the total we expect to drive the vehicle. What's 29,006 over 148,000? 20 cents. So for every mile we drive, we're going to take 20 cents in depreciation. So year 1, we drove 40,000 miles times 20 cents is 8,000 in depreciation. And year 2, we drove 46,000 miles times 20 cents a mile is 9,200 in depreciation. Should get the same answers either way. And that's everything from chapter 7. Any questions from chapter 7? Anything you want to go over? I gave you like a quiz now. You would all do very well on it. You know, if I gave you a quiz that was open book, I would know it'd be open book. The assumption is that it's the same quiz whether it's open book or closed book, and it's never that way, right? If I know it's open book, the test is different than if I know it's not open book. The worst test I ever had when I was in school, open book, open note, talk to a professional, go find a professor or anybody you want to ask. The only rule was the test was given out at the beginning of class and collected at the end. Between that, there were no rules. Now, it sounds great, except the guy knew what he was giving us. So it was made so that even under those conditions, it was still challenging. I'd much rather know the material, closed book, no note, just sit down and do it. That was always my preference. Now, it sounds like open book would be easier. No rules would be easier, but it never is. So it's just hypothetical. So if it was a hypothetical pop quiz, I'm sure hypothetically you'd all do very well. All right, so if there's no questions, then next week we get Chapter 8, Current Liabilities. The PowerPoints and the answers to both the 3rd and 4th edition have been posted to Blackboard. So recommendation is you go through, do the problems, do some extra ones. Don't understand anything, ask next week. Make sure you know it for the exam. The best example of what's going to be on the test are going to be like the examples in the book. So I don't think you're going to find an exercise that includes some of the year's digits.
So that won't be on the test, but you will find straight line activity and declining balance. Those definitely will be on the test. Sale of assets should be on the test. What to record, what to capitalize, and what to expense, like we went over, will be on the test. Any questions? All right, then I'll see you next week. Have a good week and get ready for some snow.
They have